Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. My name is Pushpendra Mehta. I am the executive writer at CTMfile and also host the Open Treasury podcast. Joining me today are Anthony Carfang, Managing Director of the Carfang Group, and Craig Jeffery, Managing Partner at Strategic Treasurer. This week, we are focusing on 5 stories, namely interest rate hikes, cross-border payments, digital payments, central bank digital currency, and supply chain finance. You can read these articles and also research content more deeply by visiting ctmfile.com or by following the links in our show notes. Our first topic for discussion today pertains to inflation in Europe, rising to a record high, raising specter of steep European central bank interest rate hikes. Tony, if I may start with you and direct this question to you, how do you think the ECB rate hikes can impact the treasury departments of corporate America? Will it result in fewer investments or a brake pedal in expansion, or is something else going to happen?
Well, the rate hikes push are a real sea change for European treasurers. We've had 13 years of zero and, in some jurisdictions, negative interest rates. The current rate hikes really changed the equation. The calculus on a project, on a capital investment, is changed. The time horizon may also change too, as higher rates seem to lengthen people's time horizon as well. The European Central Bank was slow to raise rates initially, even after inflation became visible. The U.S. was a little quicker, although the U.S. wasn't very fast either. But the U.S. has gone faster and higher. Conversely, though, in terms of the quantitative easing, the European Central Bank was one of the first to lead the globe in quantitative easing, both after the global financial crisis in 2008 and then doubling down or tripling down after COVID. The ECB's balance sheet was over 9 trillion euro. They actually grew to be larger than the Federal Reserve's balance sheet. However, they have run that off more quickly. So the ECB has scaled back the size of its balance sheet much more rapidly than the Fed has over the last 6, 7, 8 months. Now, I think that's going to change very quickly in the future as the ECB's focus is on rates and not the size of its balance sheet, although I think in the long term, the two are intricately connected.
Yeah, I would just add, if we're looking at 2.5% for the ECB, possibly rising to 4% this year, they're sitting a little bit less than 2% than the Fed in the U.S. So the expectation is still not to raise it as high as the U.S. I think everyone's recognizing that inflation's a bit stickier than the early expectation. Now, in the U.S., we had the famous transitory expectations that it would just kind of like come and disappear like a flash of light. It seems to be, maybe in geological terms, it's transitory, but it's certainly been here for some time. And I think the other expectation to some of Tony's points in terms of we need to react to these and manage it. In the early days of COVID, there was some stiff changes, very dramatic changes that happened. The vacillations that occurred were very quick and reset very, very rapidly as well, from unemployment shooting up to, a quick recovery and higher. So we're used to things coming back. And I think that sets a bit of the stage for we're going to go back to normal, normal meaning what we've seen for a handful of years, as opposed to an adjusted footing. So the expectations of increased rates, both in the U.S. And the European Union, are firm, and they're certainly having impacts on the foreign exchange rate and calculus, as Tony says. So a lot of areas to continue to pay attention to there.
If you look back over the first 20 of the last 40 years, the average rates were higher than they are today. In the late 1980s and the 1990s, we actually had robust economic growth, even in the early 2000s. High rates don't necessarily translate to slower growth. High rates translate to a different allocation of capital, though, to achieve that growth. As Craig mentioned, the markets have a great tendency to revert back to the mean, and we certainly hope that happens in terms of economic growth and vitality, but they can't revert back to the pre-COVID mean for as long as governments are continuing the COVID era supports and economic interventions. So there are barriers in the way of for the economy to revert back to the mean. And as long as the governments still believe that we're in a pandemic crisis, the markets are going to be hampered accordingly.
I know, Tony, there's quite a few people who think that, when you try to constrain activity within a certain range, you just create extra pressure that when it's released becomes more dramatic. And I think we've, to your point about quantitative easing and some of the economic activities that central governments have done to prop up and support everything from businesses to consumers to handle the lockdowns that we all saw. So I think we're still living in that shadow.
Right. After a dozen years of interest rates at zero, I would certainly hope that treasurers don't believe that we're going to get back to zero interest rates. And you have to start reorienting your thinking from everything from your pension plan assumptions, rate of return assumptions, from your cost of capital, the time value of money, the expectation of escalations in contracts with cost of living. If you believe that the risk-free interest rate is going to get back down to zero or below, you're probably making a mistake. There is a cost to capital, and that needs to be refactored into the equation.
Well, that was a follow-up question I had on my mind, but Tony, you answered it. I was going to ask you, will we ever return in the short term to zero interest rates? Well, let's move on to the next story, which is about Modern Treasury, a US-based payments provider, and Silicon Valley Bank announcing the launch of Global ACH, a solution that will reportedly allow mutual clients to send cross-border payments effectively and cost-effectively, leveraging local payment rails. Modern Treasury states that Global ACH offers a less expensive alternative to the SWIFT network and other third-party entities that charge foreign exchange fees. Tony, I know that you have a lot to say about cross-border payments. Vis-a-vis this development, do you think corporate treasury with international footprints can benefit from any differentiated or significant advantage given what this partnership or this launch plans to attain?
This is a very interesting development, and I think corporate treasurers need to take a look at it. I wouldn't dismiss the value that SWIFT brings to the global payment system, though. I mean, it has airtight infrastructure. Parties are known to each other. There are rules, there are protocols, there are technological pipes that basically cannot be penetrated, and obviously, when you do an international funds transfer through the SWIFT network, there's a cost associated with all of that. So to the extent that you move away from that, it's important to make sure that you do have the right controls, the right technology in place, the right protections, the right counterparty insurance to make sure that the payment will be completed on time and to your satisfaction. When repetitive payments happen, and I believe Modern Treasury and Silicon Valley are kind of looking at more repetitive kinds of payments, then some of the ironclad protections that SWIFT provides may not be required. If the two counterparties in a transaction know each other and trust each other, and simply happen to be in different jurisdictions, perhaps a different pipe, like the kind that Modern Treasury and Silicon Valley put together, is appropriate. But a treasurer shouldn't be confused into thinking that the two payment mechanisms are equivalent.
Yeah, I would say this story, as I looked at it, it's like, this is not a dramatic story. It's interesting. If you look at what Goldman Sachs has done on the cross-border and global payments front over a year ago now, this represents more banks moving in the direction of all of the above and some of the new activities. What are some of the key factors? There's ongoing globalization of trade, and that means treasurers need to support global trade in multiple currencies, multiple locations. And it's no longer just dealing with some of the majors. It's across the board. So ongoing globalization has continued to pressure organizations to support cross-border trade. This helps support that. Interoperability between global networks and local payment channels is such a pain. And it's, platforms like SWIFT, like this arrangement, and many other arrangements are helping reduce the hurdle and the burden. And there's quite a discussion about making global payments and what can be done. And so this is playing into all of those directions. And finally, in addition to interoperability, the use of technology to support this, like APIs, to support a faster integration and support more payment channels. This is part of that long trend of payments take too much effort, time, and money, and they should disappear. Not disappear in that they go away, but they should become almost an afterthought where it happens behind the scenes. And so I think we continue to enter a period of less and less focus on. We will enter a period of less and less focus on payments as they're handled more seamlessly in a more interoperable manner. So it's it's going to take years to transition. But Tony, do you have any thoughts on that?
In a payment system like this, it's important for the treasurer to ask the question of the banker and a modern treasury, or any other payment provider: what happens when something goes wrong? What happens when the payment that they send doesn't arrive? Who's responsible? What's the time period? What's the remedy? What jurisdiction prevails? There are a lot of complex questions that SWIFT has already answered. So if you want to reduce the cost that the SWIFT network entails, you're reducing some other very important features, like how do claims get adjudicated? Who's responsible? Where's the capital? I'm a fan of SWIFT because basically all of the significant global banks are members. Their capital is at risk. The transactions pass through central banks. They're final. They are irrevocable. As you get away from that, and you get away from the finality of payment, or the irrevocability of payment, maybe for the bulk of your payments that doesn't matter at all. For some of them, it may, and again, the treasurer is the custodian of the company's assets. The treasurer has to make sure this is buttoned up.
Our next story that merits discussion revolves around the very reasons why chief financial officers or CFOs are making investments in digital payments technology. To assess the digital payments technology investment payoffs and priorities, Payments and CoreCentric collaborated in a survey titled Digital Payments, A Changing Economy Sparks New Priorities for System Spending that polled 500 CFOs representing the healthcare, finance and insurance, retail and manufacturing sectors. Craig, upon review of the survey report, which are some of the most important findings that you believe would be of great interest or benefit to corporate treasury?
The first thing I'd say about this is go to the show notes, see the article, read up on the survey. There's quite a bit of good information that we can't summarize, in just a few minutes. But a couple things, what are we seeing to bubble up everything that's been said here is there's significant digital investment being made across these different areas of the cash conversion cycle in Treasury. A lot of these investments are reducing the number of handoffs between systems. This leads to better information, better visibility. Some of the technology leads to better information and visibility, and less handoffs. Better information and visibility creates less defects where there's confusion about information. There's a defect repair, which means calling someone or following up on that. And what does this mean? This means better everything. Better handoff, better control, better security, lower costs. And, I think the other summary from, reading this article is what drove this. There's a significant number of stressors that are happening to finance, and those are being relieved by using tech. People are increasing their spend on tech in these different areas, in payables, receivables. They're spending heavily on tech because it's giving them those efficiencies, the better capital pay, from AR to fraud, across the board, and even procurement and AP. That's the big story. People are addressing these stressors with tech, and it's solving a huge range of issues and challenges.
Which, I totally agree with Craig. The benefits of investments in digital technology from the Treasury standpoint are significant, and they really touch on almost every aspect of the Treasurer's roles and responsibilities. Fraud reduction, I think, is incredibly important here. And the digitization of the payment can go a long way toward reducing fraud in the transaction. Digitization also improves the speed. Speed improves certainty. Certainty reduces risk. I mean, as Craig said, it's the genesis of everything. Obviously, that's a very good thing. Equipped with digital processes, a treasurer has better line of sight into the receivables, more control over the payables, better understanding of the customers. And in addition, the treasurer is able, through technology, to have the payment be more of an integral part of the company's actual product. I mean, the payment contains important information that the company might use as part of its order entry system or the inventory management system, or elsewhere in the supply chain. It's really a gold mine. I was interested in the survey, and if the audience reads the article more deeply, if there was an exception to all of this, it was healthcare. Healthcare seemed to behave differently on a number of the questions that were asked. I won't steal the punchline, but my hypothesis there is that the payment side of healthcare is far more opaque because of the third parties and the indirect benefits and beneficiaries. Not that there are not significant benefits to investing in digital technology, but the benefits appear to be a little bit different than what the other treasurers reported. I just found that difference fascinating.
There's also quite a number of other differences if you look at fraud prevention, risk management between finance, insurance, and healthcare, that was a huge focus. Quite a bit less on retail, trade, and manufacturing. Still above half, 2/3 to 3/4, but the others were almost universal in their area. So, article well worth the read.
Interesting perspectives. Let's move forward to our fourth story, which is about the U.S. Treasury's plans to oversee a new task force that intends investigating central bank digital currency, or CBDC, in depth. As the Fed prepares to roll out a widely accessible real-time payment system for banks in the U.S., its Treasury Undersecretary for Domestic Finance pointed out that some of the appeal of a CBDC would vanish with an enhanced interbank payment system. Tony, do you concur with the Treasury Undersecretary that the advent of real-time payment system will somewhat diminish or reduce the appeal of CBDCs? I know Craig mentioned interoperability earlier. In your mind, what are some important issues that ought to be examined thoughtfully before a decision to introduce CBDC is taken?
Well, I fundamentally disagree that Treasury can put together a committee of people from Treasury, the Fed, and other government agencies and figure out the cryptocurrency market. There is no one from the financial sector on this committee. There's no one from the cryptocurrency world on this committee. There's nobody from the technology world on this committee. My head's exploding. I mean, am I missing something here? I mean, yes, it's appropriate that the U.S. government look at central bank digital currency, but it ought to take a complete look and not a top-down government control look. Many of the issues that this committee seems to be looking at would be if a digital currency were to exist outside of the Fed or Treasury's control, then how would the Fed or the Treasury control the economy during a financial crisis? What if lending dried up and reserves were needed somewhere? To me, that's looking at the whole thing backwards, as opposed to how a digital currency can improve the workings of the economy, the efficiency. We were just talking about cross-border payments before. A digital currency that is coordinated with other central bank digital currencies basically takes all the friction out. I mean, this should be a super SWIFT, and maybe that's what the ultimate central banking system digital currency will be. But the notion that a committee of basically people who have not worked in the industry but have only regulated the industry can't solve in a vacuum.
When I think about central bank digital currencies, I think about how slow they're moving. You think about the U.S. with the Fed, the largest economy in the world. I talked earlier about geologic time, about how quickly things would pass. But some of this activity seems like it moves at a glacial pace. It's like we've had digital currency for quite some time. And we have study groups and more study groups and new study groups. To some of Tony's points, the settlement, the movement of funds needs to be controlled, free of crime, free of terrorism. It needs to have great visibility, support the movement of funds and information so that trade is easier. It supports a more democratization of access to capital, access to movements. Payments, for example, need to become less. The overhead, the weight of doing trade needs to decrease. And so these are things I think we can keep looking at for years as they come up with plans and move forward. But, to some of Tony's point is, what's the top-down look? What are we trying to do with currency? In the U.S., what's the value of having the primary currency of the world and making that easier to trade as opposed to palletfuls of $100 bills wrapped in cellophane, all over the globe? How do we move to the new environment efficiently and addressing those needs? There's a lot more here. This is just kind of like, just keep reading and keep current on what's going on. The big advantage of, and it's not just the Fed, other central banks are looking at exploring these things, is they have the advantage of being a central bank backed by the full faith and credit of the particular government that issues that. You don't have to be first, second, or third. Mm-hmm. You can be a late mover and still, leverage the power of your ability to create massive amounts of money that has a taxing authority behind that rather than just a pure trust factor.
It strikes me that the folks who spend a lot of time talking about this look at the decision to employ a central bank digital currency as binary. Either you have one or you don't have one. It's actually falls on a continuum, and perhaps there is a digitization of currency. On the Federal Reserve's balance sheet, it's still an $8.5 trillion balance sheet. More than $2 trillion of that is currency. It's cash, dollar bills, it's nickels, dimes, quarters. Digitizing that removes a lot of cost and a lot of friction from the system. The cost of handling cash is huge. The risk of handling cash, from store safety, robberies, crime, money laundering, and all that, seems to me that's one area where the benefits are irrefutable. And that might be something to pursue without a complete digital currencization or whatever the word would be of the whole U.S. economy. It seems to me that there needs to be many more seats at the table, though, for this to happen properly.
And our next story may be about many more seats in the supply chain workings. The fifth story that I would like your insights upon is the claim that Southeast Asia is the new China for global supply chains. According to the chairperson of the ASEAN Business Advisory Council, Southeast Asia is the new China, and the 10-member Association of Southeast Asian Nations, or ASEAN, should be the supply chain of the world. Multinational corporations are redrawing their supply chains away from China. India, Vietnam, Thailand, Malaysia, and Bangladesh are stepping up to replace the world's factory, as reported in a recent article in the Business Insider South Africa website. Craig, Would you recommend more corporations and their treasury departments to geographically diversify their supply chains to reduce dependency on China, both as a market and as a supplier?
I think everybody's recommending that except the Chinese government. I think that's not a risky statement. One of the things that's interesting here is, like, hey, it's the new China. Well, it's a bit premature, but given a lot of the events that have happened, not only with the supply chain, but some of China's actions have caused quite a bit of concern across both governments and different businesses, and the need to diversify. I mean, diversification is a big risk mitigation process, and so that's there's long been too much concentration in that regard with these supply chains running through a single country like China, and so we see more of that happening. To the point that it's premature, I'd love to hear what Tony thinks on this too. Is there are a lot of foundational elements that exist in this ASEAN region with materials, with people, with an ability to grow and diversify. And so there's definitely a lot of foundational elements. The growing the ecosystem, all of the ancillary things like around just like you might have a main artery coming out of your heart, there's other ones that need to develop to grow the ecosystem. And this is going to be an area where it determines if this is the new China or if this is just a secondary area that grows and provides some offshift. But the idea of multiple sources and diversity we use that in Treasury all the time for risk mitigation, different maturity periods, lack of overconcentration, not putting all your eggs in one basket is exactly what we do all the time. And this is, I think everyone's saying that. And this is an area that stands ripe to profit from globalization and the concern and need to diversify.
Craig, I think you hit on a number of good points there. You said the foundational elements are in place. This area is rich in natural resources. It's rich in labor. I would want to think about whether the sort of the financial and legal superstructure is also as robust. Will the legal systems uphold contracts, long-term contracts? Again, how do they get adjudicated? Is there a difference from country to country on whether or not the countries require the upstream company to make a capital investment versus simply a trade agreement? It could take on a lot of forms. I think diversification is key, and we learned through COVID that it's important to diversify your supplier base. I'd like to point out that before supply chain became supply chain, as we all love it today, in the early days of my career, it was simply a given that, a company wouldn't have a supply chain department, they would have a purchasing manager or purchasing department. And for every major component that a company needed to acquire, there was one vendor that had 60% of the business, another vendor at 30%, and a third vendor at 10%. They had three vendors who were all vying to move up the chain to get to the coveted 60% spot. And so the companies arranged for vendors to compete with each other. They had a minimum of 3 suppliers for every product. It was diversified. It's a little costlier to do that. But now we're seeing what the cost of not diversifying your supply chain is. And I think it's time for companies to kind of step back and think about what the right balance is there. And yes, of course, these other Southeast Asian countries are a natural place to become part of the supply chain. I would also say the supply chain with China in sort of the central position that it has been in the last several years will probably not come back. The notion of one major supplier from one country and being a sole source, I don't think is going to come back.
Yeah, as you took us down memory lane, Tony, there was the focus. Remember, it wasn't that long ago that it was just-in-time inventory, this idea that we de-levered our balance sheet by not taking inventory and having it delivered at the last moment. We've seen, that seemed less costly until we realized it was a lot more costly. And so we go from just-in-time inventory to just-in-case inventory, and we go from single-source efficiency to multi-source diversification. So those are all big takeaways, and this maturing of, I think, the learning as we've gone more global. We've had some, onshoring, offshoring, nearshoring, friendshoring. All of these activities are maturing to reflect the reality that we're seeing. And I think that diversification plays a part, whether or not it seems to be paying off in the very short term.
Tony and Craig, what is your choice for the most important story of the past week, and why? Craig, if I could ask you to go first.
For me, it was easy. I mean, the whole rate hikes is a significant issue going on, but the biggest story is Southeast Asia being the new China. I know we've been talking about that, but that is probably one of the most rapid shifting items that's happening. This additional diversification, sourcing from different places. I think that's good for the globe. There's a lot of these countries that aren't particularly wealthy that this will help them. And I don't think it's bad news for China either. I think there is this idea of seeing, if we're a better global citizen, things will go better for us. And there's been some places where they haven't been a particularly good global citizen. I think companies in some cases have been myopic. And so that seemed to be the biggest story across this range of items. And there's quite a bit here to sink our teeth into, but that's my number one story if we're going by stories.
Well, Push, as a monetary policy guy, I've got to get to the ECB's priming European treasurers for higher rates. But actually, there's a sort of a corollary to that, which should be the ECB should be priming treasuries for a recession, because that's what's going to happen with the higher rates and monetary policy. It didn't get any play at all in the press, but late last week, the Federal Reserve released its January U.S. money supply numbers. And in January, the U.S. money supply fell. Year over year, it has fallen 2%. It has never, in the Fed's time series for the current series of money supply, fallen 2% in a 12-month period until Friday's release. This is tightening to the extreme. And it's tightening in the sense, not raising rates, but taking liquidity out of the system. Treasurers are going to have to understand how to manage their balance sheets, conduct their financial transactions in an environment with significantly less liquidity. To me, that's critical. Money supply, changes in money supply are a leading indicator of changes in nominal GDP, not real GDP, but nominal GDP. So when we see money supply slowing down, we can think 9-12 months out that nominal GDP should slow down, and real GDP is nominal minus the inflation rate, which means an even greater slowdown. So the ECB should be warning not just on higher rates, but on the repercussions of that, which is a slower growing or contracting money supply, and that leads to economic slowdown.
You didn't say recession, though.
All right, I'll say it. Recession. I'll say recession with a capital R. In the history of this particular time series in the Fed, going back to Paul Volcker days, it has never contracted this much this fast.
Thank you, Tony and Craig, for your valuable insights. I have immensely benefited from these, as I am sure our listeners would too. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.